Section 3:2 Understanding the Volatility Index, VIX, 3.2 Market Conditions and Economic Factors. Market conditions, economic indicators, and geopolitical events can significantly influence the VIX, reflecting changes in market sentiment and expectations of future volatility. Here's an analysis of how these factors impact the VIX. Market conditions. The overall state of the financial markets plays a crucial role in influencing the VIX. Bullish or bearish market conditions can affect investor sentiment and risk appetite, which in turn impact the VIX. During periods of market stress, such as financial crises or sharp market downturns, the VIX tends to spike as fear and uncertainty increase. Conversely, during periods of market stability and optimism, the VIX tends to decline as risk appetite rises. Economic indicators. Economic indicators provide insights into the health of the economy and can impact the VIX. Poor economic data, such as weak GDP growth, rising unemployment, or declining consumer confidence, can increase uncertainty and lead to higher VIX levels. Positive economic indicators, on the other hand, can boost investor confidence, lower perceived risk, and result in lower VIX levels. Economic events like central bank policy decisions, interest rate changes, or major economic reports can influence the VIX based on their impact on market sentiment. Geopolitical events. Geopolitical events have the potential to disrupt financial markets and increase uncertainty, which can be reflected in the VIX. Geopolitical tensions, conflicts, trade disputes, or political instability can lead to higher VIX levels as market participants react to the potential impact on global economies and market stability. The VIX may rise in response to unexpected geopolitical events, as they introduce additional risk factors and uncertainty into the market. Investor sentiment, market participant sentiment and emotions play a significant role in shaping the VIX. Fear and greed, along with herding behavior, can influence the VIX as investors collectively adjust their expectations and risk perceptions. Negative sentiment can drive up the VIX as investors seek to hedge their portfolios and protect against potential losses. Positive sentiment can lead to lower VIX levels as investors become more optimistic and willing to take on risk. Volatility feedback loop. The VIX can also have a feedback loop effect on market conditions. When the VIX rises, it can trigger selling pressure as investors become more risk-averse and seek to reduce their exposure to volatile assets. This selling pressure can, in turn, lead to further market declines and increased volatility, reinforcing the higher VIX levels. It's important to recognize that the VIX is influenced by a combination of factors, and their impact can be interdependent and complex. Market participants should consider a range of information, including market conditions, economic indicators, geopolitical developments, and investor sentiment, to gain a comprehensive understanding of the factors influencing the VIX and make informed investment decisions. Economic data releases and global events can have a significant impact on volatility levels in financial markets. Here's a discussion of how these factors influence volatility. Economic data releases. Economic indicators, such as GDP growth, inflation, employment figures, retail sales, and manufacturing data, provide insights into the health and direction of an economy. Surprises or deviations from market expectations in these data releases can lead to increased market volatility. For example, positive economic data that exceeds expectations can boost market sentiment, leading to lower volatility levels as investors become more optimistic about the economy and market conditions. Negative economic data that falls short of expectations can raise concerns about the economic outlook, increasing uncertainty and potentially leading to higher volatility levels. The impact of economic data on volatility can vary depending on the specific indicator, the magnitude of the surprise, and the prevailing market sentiment. Central bank actions and policy decisions. Central banks play a crucial role in shaping monetary policy, interest rates, and liquidity conditions. Market participants closely monitor central bank decisions, statements, and press conferences for clues about future policy direction. Central bank actions, such as interest rate changes, quantitative easing, or shifts in policy guidance, can significantly impact volatility. Unanticipated or unexpected central bank decisions can trigger market reactions and lead to increased volatility as investors reassess their positions and expectations. Geopolitical events. Geopolitical events, such as political developments, elections, trade disputes, geopolitical tensions, or military conflicts, can introduce significant uncertainty and increase volatility in financial markets. These events have the potential to disrupt global economies, impact trade relationships, and affect investor sentiment. Heightened geopolitical risks often lead to higher volatility levels as investors react to the uncertainty and potential consequences of such events. Global macroeconomic events, global events with broader implications, such as major policy announcements, geopolitical crises, natural disasters, or global health emergencies, can have a widespread impact on financial markets. These events can disrupt economies, supply chains, and investor confidence on a global scale, leading to increased volatility levels. The uncertainty and potential economic ramifications associated with these events can cause significant market fluctuations. It's important to note that the impact of economic data releases and global events on volatility levels can vary depending on the specific circumstances, the market's current sentiment, and the interplay between different factors. Market participants closely monitor these events and data releases to gauge potential market reactions and adjust their investment strategies accordingly.